24 trillion, almost $25 trillion in national debt. This is the US debt clock. If you look in the top left-hand corner right there, you'll see $24.95 trillion in debt. This is the amount of money that we owe, and this is one of the primary reasons why you have to be concerned about taxes in retirement. Most of you have money inside these tax-infested accounts, 401ks, IRAs, and these are the accounts that every time you take money out, you are subject to income taxes. So this is the amount of money we owe, but if we go forward, they have this little debt clock time machine here. If we fast forward to 2024, $42 trillion in national debt. So if you look in the top left-hand side there, this is 2024, and this is how much debt we will have as a nation in 2024. Now, it's important to recognize the primary drivers of this national debt. So if you look at the very bottom of the screen in the red, it says Social Security liability, Medicare liability, and U.S. unfunded liabilities. So we owe 24 trillion in counting of Social Security, 39 trillion in counting towards Medicare liabilities, and total promised payments of $187 trillion. Now, to put this into perspective, if you started counting to a trillion, it would take you over 32,000 years to get there. So when we talk about paying less tax in retirement, these are some of the primary drivers, and it doesn't matter if you are in retirement or about to be in retirement. The primary drivers of the debt are Social Security, Medicare, Medicaid, interest on the debt. So we're going to jump right into the presentation here. As we start to talk about taxes, today we're going to cover a few main things. We're going to cover how do you pay less tax on your Social Security benefits. We're also going to cover how do we pay less taxes on our dividends and capital gains. There is a 0% tax bracket for capital gains and dividends. And then we're going to have a case study at the end of this presentation, the last probably 15, 20 minutes, where we are going to go through a case study where we helped a family reduce their estimated tax liability in retirement from $625,000 to $185,000 approximately. So we're going to hop right into it here. And I am Troy Sharp, CEO of Oak Harvest Financial Group. We are Dave Ramsey endorsed local providers. A quick disclosure slide. We have these on the website as well. I encourage you to visit the website, oakharvestfinancialgroup.com. Many of you have listened to me on the Retirement Income Show. So for the past 10 years on KTRH 740 AM, I've hosted the Retirement Income Show where we talk to you about how do you pay less tax? How do you make income last for as long as you do? So if you haven't heard the Retirement Income Show, every Sunday at noon after church, 740 AM, KTRH, I encourage you to tune in. For the past 10 years, we've helped over 1,000 families just like you plan for retirement, reduce their taxes, generate income, and reduce risk in their portfolios. So I am the CEO. Jessica Cannella is the president and co-founder of Oak Harvest Financial Group, and Jared Kenny is our vice president as well as a financial advisor. I've sat with thousands of families personally over the course of my career. We've helped thousands of families here at Oak Harvest Financial Group. And even though every single situation is different, we all have the same questions. Do I have enough? Can I retire? How long will my money last? How do I pay less tax? And if something happens to me, will my family be okay? Now, when we talk about some of the most punitive aspects of the tax code, we're going to share with you the most punitive aspect that virtually all of you are guaranteed to fall into. And this tax trap can increase your taxes. We typically see between 40 to 60%. So there are many minefields in the tax code, and we're going to cover them today. But the important thing is that you have a plan that helps you get through this. So our core values, very straightforward. Number one, do unto others as you'd have them do unto you. Be transparent and honest in all our dealings, and then provide second mile service. So second mile service comes from the Bible, Matthew 5:41. If anyone asks you to go 1 mile, go with them 2. That is something we take very seriously around here as we build retirement plans for our clients through our Retirement 360 process. Our relationship begins when you put your plan in place, and we're here to guide you as a partner through retirement as the years progress. Okay. So Retirement 360, this is our process here at Oak Harvest Financial Group. And the first step is investment planning. Number 2 is income planning. Number 3 is tax planning. Number 4 is healthcare. And number 5 is estate planning. We call it Retirement 360 because I went through the school of hard knocks with my grandparents. My grandfather raised me along with my grandmother. And when they retired, they only had step 1. Their advisor only put step 1 in place for them, which was an investment plan. They ended up spending over $1 million in healthcare costs, home healthcare, nursing care. My grandfather had 2 aneurysms 5 weeks into retirement, and I saw the stress that it put on my grandmother, my family, concerned about running out of money, where it was going to come from. So from that experience came Retirement 360. We do have an attorney and CPA available also through Oak Harvest Financial Group, and the goal is to be a one-stop shop where we can put together an investment plan, an income plan, tax plan, healthcare, and estate plan, and of course partner with you as time goes on to carry the plan out. Myself, Troy Sharp, I have a finance degree from Florida State, completed my CFP studies at Rice University, and I am investment licensed and also life insurance licensed. Chris Paris on the screen here is our Chief Investment Officer. This is one of the ways we keep costs down for you is by managing the money in-house. Chris has his MBA from Harvard, and he's also managed the #1 mutual fund in the country, as well as the #2 fund over both 3 and 5 year periods. So world-class investment management that is designed to help put together an investment strategy, manage that plan moving forward to help achieve the long-term objectives. Our primary responsibilities, #1, is to protect your retirement. And we do that through customizing retirement income, investment, and tax plans based on your needs and according to our core values. Also, to act in a fiduciary capacity as a partner in retirement that deploys our resources, our team, our expertise to optimize your journey throughout retirement. We have a financial planning team, we have a tax team, and we have the investment management team that work in conjunction with your financial advisor to be partners, to be resources as time goes on to help monitor when you're in the maintenance phase of the Retirement 360 process. So real quick, income planning is the process of determining when to elect Social Security, along with determining how much income to withdraw annually and from which accounts, with the goal of extending portfolio longevity. So do you take from the IRAs and how much? Do you take from the non-IRAs and how much? Do you take from the Roth? When to take Social Security? How does all of that come together in a retirement plan is what income planning is. Tax planning is the process of determining the most tax-efficient distribution structure and actions to take that reduce taxes over the course of your retirement. So one of the things to grasp about income and tax planning is that every single decision you make at this stage impacts everything else. It impacts how long your money will last, how much income you can take, how much tax you'll pay, how long or how much money will be left for healthcare, medical, inheritance. Every decision, they're like dominoes in retirement. They impact every other aspect of your plan. So a proper income and tax plan requires reviews with your advisor and the team to implement and execute the recommended path, but of course to adjust. Going through the coronavirus right now, this is put into perspective the importance of having flexibility within your plan and also a partner there to help guide you as time goes on, because this is not the last crisis we'll go through. This is not the last 30% drop in the market. Typically, peak to trough in a recession, markets do decline about 30%. What's been different about this one has been the swiftness with which it has occurred. So we want to generate multiple streams of income, living off interest, not touching principal, and we do that through the Retirement 360 process and our Core 4 framework. So the income planning, just a quick visual here. Again, how much do we take from IRAs? How much do we take from non-IRAs? How much do we take from our tax-free bucket? These are the dominoes that the decisions we make will determine everything else in regards to how much tax we pay and how long the money lasts. One aspect of tax planning is not only the withdrawal amount that we take from each bucket, but the investment placement. Are we putting the right tools inside the right buckets to create the most tax efficiency possible? So a lot of times when we sit down with clients just like you, we see that they really haven't made it past step one, the investment planning process of Retirement 360. And step two is income planning. Step three is tax planning. These often have a bigger impact on your retirement than which stocks, bonds, or mutual funds that you're invested in. Okay, so Vanguard, they put out this recent study. It's called the Vanguard Advisor Alpha Study. And they talk about what I'm telling you here today: income planning, asset allocation, tax planning. The study says that a good advisor can equate to about 3% per year increase in your investment returns over the course of your retirement. 3% per year compounded over the course of your retirement. For many of you, this is millions of dollars. And again, this is getting past step one of the Retirement 360. So often when people call in from the Retirement Income Show, or when we sit down with you in person, or during the coronavirus, right now we're doing phone calls to get to know what's important to you, we find that the only thing people really have is an investment plan. And that's not going to cut it in this day and age. Every decision impacts everything else. It determines how long your money will last. And of course, making mistakes during this period can have catastrophic consequences. Okay, so right now we're going to hop into how do you pay 0% tax on your dividends and your capital gains. So investment placement, where we take income from. This is the domino effect that I've been talking about. And if you are married filing jointly and you have taxable income below $80,000, you will pay 0% taxes on your dividends and your capital gains. If you're not taking itemized deductions and you're just a standard deduction person because the standard deduction has been increased under the Trump tax cuts, you can have an adjusted gross income if you're under 65 years old of $104,800 and still pay 0% tax on your dividends and capital gains. If you're under 65, it's 107.4. So you get a little, if you're over 65, it's 107.4. So you get an extra deduction, $1,300 per spouse that is over the age of 65, which increases the amount of adjusted gross income you can have before you're paying taxes on your dividends and capital gains. If you're a single filer, taxable income 40,000 and below. So remember, so you have your adjusted gross income, then you take your deduction, and that amount that's left is your taxable income. If you're single, if that's below 40,000, your dividends and capital gains are tax-free. So we're going to look at an example here. So Joe and Betty are both 67 years old. Their spending goal is $85,000. They have $40,000 of dividends, $10,000 of capital gains, and $45,000 of Social Security income. So they chose a common, but in this case, incorrect, because they could have filed a restricted application and significantly increased their benefits. We recently helped a family with this strategy, filing a restricted application, and it gave them an additional $1,000 per month in their Social Security and maximize their benefits over the course of their life. So what they did, if we look at this next slide here, I've highlighted where I want you to focus on. So $10,000 in capital gains, $40,000 in dividends, and then below there, 0% long-term capital gains. So that is the amount, $50,000, the dividends and the long-term capital gains that flows into the 0% bracket. So that means they paid 0% taxes on those long-term capital gains. Now, as professional retirement planners, when we have this conversation with you, for those of you who are going to want to have a conversation with us, and we're going to have a phone call that talks about what's important to you. Many of you are going to say, Troy, I want to reduce taxes today. And we're going to have to weigh that against paying less tax over the course of your life, because many of you, there are hundreds of thousands of dollars that you're leaving on the table currently because you don't have an investment, or an income and a tax plan. So if we see here in this example, their long-term capital gains, their dividends, all 50,000 of them fell into the 0% tax bracket. And this can be done in retirement because of the Trump tax cuts right now. The total tax they paid on all of that income, $283. So now we're going to look at an alternative strategy here. Let's say instead of electing Social Security, what if this couple decided to live off their savings and then do a Roth conversion? Okay, because when we're trying to pay less tax over the course of our retirement, we have to do this in a strategic way that optimizes income and taxes today, but also income and taxes over the next 20, 30 years. So, same amount of dividends, same amount of capital gains. And instead of taking Social Security, they deferred it and withdrew $45,000 from savings. Now, they've done a Roth conversion of $45,000 in this example. So that means they've taken money from their tax infested IRA and moved that over to the tax free Roth IRA. Deferring Social Security, filing the restricted application sooner, Social Security jumps up to $59,400 in this example. So here we go. We have now IRA distribution. So this is a Roth conversion of $45,000. You see below that, long-term capital gains and dividends, the same amount as the previous example. And still, all capital gains, all dividends fell into the 0% tax bracket. But the total tax, $1,760. So this was an optimal Roth conversion strategy for them because they kept taxes low today. Okay, they're only paying $1,700 and $1,760 on a $45,000 Roth conversion, plus their dividends and capital gains are tax free. So they've not only in this alternative example increased the Social Security benefits permanently for life, did a Roth conversion, moving $45,000 to the tax-free account out of that tax-infested IRA, and only cost them $1,700. So $1,500 more than the previous example, and this is a far better strategy for the long-term health of their portfolio. And many of you are in this same situation, and it's about optimizing the income plan and the tax plan with respect to today, but also our long-term goals. Again, step one, investment planning. Step two, income planning. Step three, tax planning. It's what we do with the Retirement 360 process. Okay, Social Security. So oftentimes I talk to people and they say, Troy, I paid Social Security taxes my whole life. I've paid income taxes. I've paid school taxes. I paid all these taxes. Now I'm in retirement. I'm tired of paying taxes on my Social Security. Is there anything that I can do to reduce the taxation? And in many instances, yes, there are. So it's important to understand some very basics here. So Social Security taxation is calculated off what's known as your provisional income. So for most retirees, this is your adjusted gross income. So all of your gross income, plus you add back in any tax-free interest from municipal bonds, for example, and then 50% of your Social Security benefits are included in this calculation. So whatever your provisional income is, that determines which tier, okay, there's three tiers of Social Security benefit taxation you fall into. Now, it's easier for middle income retirees to reduce taxes on their Social Security benefits than somebody in a higher income scenario. So higher income would be 80,000, 90,000, 100,000 or more per year. But if you're in that, let's say 30,000 to 60,000, maybe 30 to 70 range for retirement spending, okay, through optimal investment placement and also distribution planning, it very well may be possible that you can reduce the Social Security taxation, possibly even to zero. So important to note here that the most tax efficient withdrawal strategy, so excluding Social Security here, we're talking about which buckets do we pull from. The optimal tax efficient withdrawal strategy from your financial portfolio is normally completely different for middle income retirees and high income retirees. So two different planning strategies here, but we're going to look at some of the basics when it comes to taxation of your benefits. So if we look at the middle box here right in front of us, if you're a single filer and your provisional income falls in between 25 to 34,000, 50% of your Social Security benefits are tax-free, and then you'll have to pay income taxes on 50% of them. Now, if you have less than $25,000 of provisional income, 100% of your Social Security benefits are tax-free. If you're married filing jointly, that threshold is between 32 and 44,000. And if your provisional income is less than 34,000, 100% of your Social Security benefits are tax-free. So, and if you're above those two thresholds, the 34 for single filers and 44 for married filing jointly, 85% of your benefits are subject to income taxes, and there's not much getting around that. So again, higher income retirees, a bit more difficult to get to the 0% Social Security tax bracket. But if you're in that middle income range, by adjusting the income, the investment placement, where you have your bonds, where you have your stocks, where you have your CDs, your annuities, for example, you can possibly get into the 0% Social Security tax bracket. Okay, so Social Security benefits. Here's another case study. We have John and Becky, both 66 years old, and they have a spending goal of 65 grand per year. Social Security benefits are 50,000 combined. They have muni bonds. Muni bonds, very popular for tax-free income of $30,000. They help to protect the principal and tax-free income. That's great. And also government bonds of $30,000 in interest. So they're conservative investors. Most of the money is invested in CDs, cash, municipal bonds, and government bonds. They've accumulated enough. They don't spend a ton. They just want their money to be secure. If we look at their tax analysis, they have ordinary income of $30,000. So this is from the government bonds and the CD interest. They have Social Security of $50,000, and then highlighted in yellow, the tax-free interest of $30,000. Now remember, provisional income includes your adjusted gross income, so all of your income, plus your tax-free income, plus 50% of your Social Security benefits. So that means the tax-free interest is included of $30,000, half of the Social Security, so 25, so that puts us to 55, and then the 30,000 CD and bond interest is 85. So if you go down to the third highlighted, it shows taxable Social Security, 40,850. So out of their $50,000 in Social Security income, 85% is subject to income taxes, or 40,850. That results in a total tax of $4,819 for them. Now, an alternative scenario. So and here's what was going on. They wanted their money secure. They wanted it protected. So like a lot of people, they invested in CDs and bonds. But combined with the Social Security income, it created taxation. They didn't need the income. They weren't spending the muni bond interest. They weren't spending the CD interest, and they weren't spending the government bond interest. But that interest was causing Social Security to be taxed. It was dragging their Social Security into that range, the threshold or tiers where taxation occurs. By simply replacing their bonds and CDs with safe fixed annuities, their total taxes went to zero. So fixed annuities are tax deferred instruments. There are a few different ways to do this, but by having tax deferral on income you don't need, a lot of times we find out that it can save you thousands of dollars potentially on your Social Securities. So there are a lot of really good fixed annuities and fixed indexed annuities in the marketplace right now that can provide 3, 4, 5% interest, protect the principal, and put you into a position to where if the market goes down, you don't lose money. So they're alternatives to bonds, CDs, and munis, which can help your Social Security taxation. So now when we look at the tax analysis, by getting rid of the taxable interest created by CDs, bonds, and for purposes of Social Security taxation, the municipal bonds, they have the Social Security income of $50,000, which achieves their objective, and they pay 0% taxes. So by altering the investment placement, the tools that they're using, the total tax goes to zero. Now, as a certified financial planner, utilizing this Retirement 360 process, we don't care which tools you use, whether they're stocks, bonds, mutual funds, real estate, CDs, annuities, but we do care about the impact on your retirement taxation and also the portfolio longevity. So if we can use different tools that provide the same level of security but reduce taxes, saving you potentially thousands of dollars, for a lot of you, that makes a lot of sense. Now, most of you probably have not heard of the tax torpedo. So this is the section of the tax code that results in your Social Security benefits creating more taxation on your other income. So essentially, when $1 of other income, so CD interest, bond interest, pension, any other income you have in retirement, when $1 of that other income causes more of your Social Security to be taxed. So if we take a $1 and go into one of those tiers, that causes more of our Social Security to be taxed. This is what we call the tax torpedo. And that can increase the marginal tax rate to 150 to 180% of your current tax bracket. Because not only do you pay tax on that extra dollar, let's say you've taken out of your retirement account, but that extra dollar you've taken out has now caused one more of your Social Security to be taxed. So now you're paying tax on this dollar you've withdrawn, but also now on your Social Security benefits that you would have not otherwise paid taxes on. So for some households and scenarios, it can be more, but very, very important here. After the Trump tax cuts expire in 2026, this problem will worsen. So right now, you have a window of opportunity to take advantage of the Trump tax cuts. They expire at the end of 2025. This problem will exacerbate when the old tax rates return under current law. And depending on what happens in November with the presidential election and the House and the Senate, this could be a bigger problem sooner rather than later. So if we look here, this is a financial example of the tax torpedo. So assuming this married couple with $60,000 in Social Security income, if they take or have other income between 0 and 17,784, they're still in the 0% bracket, okay, marginally. But if you look between 17,784 and the 1, 2, 3, fourth row, 66,941. If you look at the far right-hand column, this is the marginal tax rate that you will pay on that one extra dollar you've taken from your IRA. So this is what we call the tax torpedo because it torpedoes your income. On dollars between 60,000 and 66,000, almost 67, every dollar you take out of your IRA will be taxed at 40%. Even though if you look at the income tax bracket, the middle column, your marginal income tax rate is only 22%. So this may be confusing for some of you, but it's okay. It's confusing in general. What's important is to understand that there is this range of taking money out of your IRA, or if you have other income such as CDs or bonds that is generating interest that you have to pay taxes on, that income creates more taxation of your Social Security that would not otherwise be taxed. And in these ranges, you can see taxation between 150 to 180% of your actual tax bracket. So when we have the phone call with you and we're talking about what's important to you on this first visit, this is what we're looking at as far as how much income you have, your expenses, what's important, your dreams, your vision for retirement. Because in order to do the analysis that we're going to provide on the second appointment, we need to have this information. So the reports that we're seeing here, this is what we cover on the second visit with you. We're going to do this through Zoom where we're sending you a link and we're going to simply go through the reports and look at how much taxes you could potentially be saving. But the tax torpedo is one of those areas where many of you are falling into and paying a higher amount of tax that you don't necessarily have to pay if there were a more strategic tax plan in place. So before we get into the case study where I show you how we helped a family save over $400,000 in retirement taxes, and then also covering the most punitive aspect of the tax code, in my opinion, I have to spend some time on Medicare because Medicare taxes are a silent killer for many of you. And we've been these Medicare taxes through tax planning, but unfortunately, there are millions and millions of people in this country who are going to end up paying these exorbitant taxes on top of their Medicare premiums because either A, nobody's talked to them about it, they have never heard of it, or simply unaware, never had a tax plan in place. So some basics. Medicare Part premiums this year, 2020, are $144 per month per spouse. According to the 2018 Medicare Trustees Report, Medicare Part B premiums are expected to increase 8% per year over the next 6 years. So Medicare, one of the biggest areas of inflation, along with other healthcare costs, when we look at your out-of-pocket, your prescriptions, your copays, your deductibles that you'll experience in retirement. For single filers with incomes greater than $87,000, and if you're married filing jointly and your income is greater than $174,000, you are subject to IRMA. So this is the tax trap. IRMA is an acronym. It stands for Income Related Monthly Adjustment Amount. This is an additional tax on your Part B and your Part D Medicare premiums. So this can cause your monthly Medicare Part B premiums per spouse to increase anywhere from $1,728 per year per spouse to over $5,892 per year. So we're talking $3,400 roughly per year total combined if you're married Medicare Part B premiums versus over $11,600 in Medicare premiums per year. So big difference. Now, the Part D premiums also can increase up to $916 per year per spouse. And the income thresholds that we need to be cognizant of to help avoid these IRMA tax penalties, tax penalties, essentially. If you're married filing jointly, it's $174,000, $218,000, $272,000, $326,000, and $750,000. For single filers, they're listed there: $87,000, $109,000, $136,000, $163,000, and $500,000. It's important to note here that tax-free income from your municipal bonds, again, if you're a muni bond investor, it may be federally income tax-free, but it does count towards your modified adjusted gross income, which is what determines your Social Security taxation and also any increased taxes on your Medicare Part B and Part D premiums. So now these levels of income and why I believe millions of people will end up falling into these brackets is because of what we call the RMD dilemma. Now, conventional wisdom tells you to defer your IRAs for as long as possible, live off your non-IRAs, and typically people are told either to defer Social Security until they're 70 or take it as soon as possible to help preserve your savings, both of which could be wrong depending on your personal circumstances. But conventional wisdom is deferring your IRAs as long as possible, living off your savings. Now, for years, while advisors have been telling you to do this, for years on the Retirement Income Show, during our live events, sitting down with families and helping them plan for their income taxes, Medicare taxes, income investments for retirement, we've been telling you the opposite. We need to get money out of those tax-infested retirement accounts, and there has never been a greater opportunity than right now to have a plan in place to help get money out of those retirement accounts. So locking in today's rates is the key to getting into the 0% tax bracket for life. We do that through strategic tax planning, not just today, but we have to identify what is the proper increment over a series of years, the amount also in those increments to help reduce taxes as much as possible, not only during your life, but because the new Secure Act that was passed in December of 2019, your beneficiaries are also forced to fully distribute your non-spouse, so your kids and grandkids, fully distribute every single dollar inside your retirement account within 10 years of inheritance. So if planning for legacy is important to you, this is a big, big aspect of doing it the right way. So I do firmly believe taxes will be higher for many reasons. As the U.S. debt clock, when we opened up this live learning online event, showed that $25 trillion in debt and growing rapidly. The Federal Reserve keeps printing money. So we've printed trillions and trillions of dollars. We have injected it into the marketplace, into the economy, not only after 2008, but of course with this COVID-19 economic crisis that we're going through here. And this was shocking the first time I read it. But by 2026, the CBO, the Congressional Budget Office, says darn near 100% of all of the tax revenue that comes in will go towards paying our mandatory expenses, which again, Medicare, Medicaid, Social Security, and interest on the debt. So again, regardless of who's president, Republican, Democrat, it doesn't matter. As far as the primary drivers of debt in this country, Medicare, Medicaid, Social Security, interest on the debt, and a few other government healthcare programs, they are constitutionally mandated to be paid. And they're growing because 10,000 people retire every single day in this country at such a large rate. The expenses we have as a country will continue to drive the debt because we do not have enough tax revenue coming in to pay our bills. So everything else the government spends will have to be borrowed. whether we're talking, Department of Homeland Security, the FBI, the CIA, Department of Education, all of that has to be borrowed. So if we don't have a plan in place to lock in today's tax rates, you're essentially saying, yes, sign me up for the government plan. And their plan, if taxes go up to 40, 50, 60, 70%, that'll be their plan to get that much of your retirement accounts. Okay, so how I help the client reduce their estimated retirement taxes from $627,000 to $186,000. So I do believe our current tax rate environment will be the lowest for the rest of your life. Current tax rates do expire in 2025. And again, there is a limited window of opportunity to get this done the right way. Case study, Tim and Tina, ages 61 and 60. Tim and Tina have $1 million in their retirement accounts, $300,000 in non-IRA savings. So this is what we call non-qualified money, a spending goal of $75,000 per year, increasing 2.25% per year for inflation. Tim's Social Security is $2,800 per month at full retirement age, and Tina's is $1,000 per month at full retirement age. So they were long-time listeners to the Retirement Income Show. They came to see us because they felt their advisor didn't have the team or experience to help build a tax plan, but also to navigate through the retirement phase of their financial life. They were planning on turning Social Security on early in order to preserve their savings. So this is something common that we hear. Their advisor wanted them to follow the conventional wisdom retirement distribution strategy, where they were to defer their IRAs for as long as possible, living off their $300,000 of non-retirement account money. And they were also told that Roth conversions could be beneficial for them, but they'd have to go talk to their CPA because their advisor couldn't provide tax advice. Well, my opinion has always been, as a fiduciary, you cannot act in your client's best interest if you are not providing tax planning. So there's a big difference there. In retirement, tax planning is a critical part. And I do not believe it is possible to act in someone's best interest unless you're looking at the taxation, the various decisions you make because of that domino effect will have on your overall retirement. So this is why we do have a CPA and also an attorney to work with you here at Oak Harvest Financial Group, as well as the tax planning services that we provide. Okay, so using our proprietary Retirement 360 process and Core 4 framework, we were able to help them answer the big questions. Number one, do you have enough money? Number two, how long will it last? How much income and from where should I withdraw it? And how do I pay less tax? And if something happens to me, will my family be okay? So step one, step two, step three of Retirement 360, investment plan, income plan, tax plan. During this analysis, which is what we're going to do for you on the second visit. So the first visit, we're going to gather this information so our tax team, financial planning team, and investment team can do the analysis. On the second visit, we send you a Zoom link and you're able to share our desktop just like you're able to see my computer screen right now. And we're going to go through your customized analysis for you on that second visit. When we did this for Tim and Tina, we uncovered that the conventional wisdom retirement distribution strategy, where they were being told to defer their IRAs, we found out that that was the exact wrong method to do. So we were telling them they needed to look at it from this angle. Taking Social Security based on their life expectancy, their health, what was important to them, would have been a big mistake as well. So we developed a plan that created approximately $1.15 million in more value and reduced their estimated retirement taxes by $440,000. By doing that, by putting that plan in place, we're able to help them answer the big questions. Can I retire? Do I have enough? How long will it last? How do I pay less tax? And if something happens to me, will my family be okay? Okay, so on the left-hand side, this is the conversion schedule that our team came up with that was optimized for their particular situation. So remember, they had $1 million in retirement accounts. So if you look at this conversion schedule, from 2020 through 2025, taking advantage of that window of opportunity that we have available to us, 108,000, 100,000, 92, 89, 86, and then a little bit in 2025. So for Tim and Tina, converting 100% of their IRA, the full $1 million account, was not the optimal structure. This was the optimal structure. And we look at those conversion amounts, and you may be thinking, Troy, well, that's a lot of money in taxation. But again, we are in the lowest tax rate environment in your life. And I also believe it will be the lowest tax rate environment for the rest of your life. So on the right-hand side, I've highlighted here how much taxes. So this is the tax analysis we provided. And this is what we're going to do for you if you decide to have this the phone call with us. The total taxes in 2020, doing that conversion, 10,868. Next year, 10,000, 98, 99, 95, 5,000. So because of the lower tax rates right now, we can do larger conversions. We need to do the optimal structure based on your customized plan, but it doesn't mean we're going to have 20, 30, 40, $50,000 in taxes necessarily. Now, if you have $2, 3, 4, $5 million in these tax infested accounts, the tax bill may be higher, but you're going to receive more value by having the proper structure in place. Now, it's important to understand life expectancy when we're making these decisions, the averages with in society today, but as well as your personal situation, because Social Security is a big decision, Roth conversion is a big decision, and understanding the statistics is important. So 1 in 2 men will live to 90 years old. So if this is you are age 65 today, 1 in 2 women will live to 92. And if you're married, 1 out of 2 of you is likely to reach age 96. So on the right-hand side, we have some statistics there as far as women and men. But if you look there, 25% of people, if you're married, will make it to age 100. So we have to be planning. I believe this is one of the biggest mistakes that I encounter time and time again, is that we underestimate the advancements in science, technology, and medicine that will be created over the next 5, 10, 15, 20 years that will continue to increase our life expectancy. So I'd rather plan for a longer life than a shorter life because it's a lot easier or more comfortable to have income, to have a plan that if you make it into your 90s or beyond, that you're not worried about money or income. Okay, so here is the comparison scenario. So on the left-hand side, this is what Tim and Tina, what their advisor was recommending them to do. So take Social Security early to preserve the assets, live off your non-retirement accounts, so live off the savings. And then on the right-hand side, we have the Oak Harvest plan. So if we look first, I've highlighted age 70. And if we look under Social Security, 40,000 versus 67,000. So you see at age 68 and also 69, this is filing a restricted application that they completely overlooked. We recently helped a family file this restricted application. Not everyone qualifies for it. It depends on your age and filing and timing. But we recently helped a family get an extra $1,000 per month with this strategy. So for many of you, it may be something we'll look into for you. But the Social Security benefits increased $27,000 per year, guaranteed for life, of course. And I want you to focus on the middle column now, the taxes. So on the left-hand plan that their advisor was recommending they follow, the conventional wisdom strategy, they were paying 0 taxes for about the next 10 years. Well, I don't want to pay 0 taxes in the lowest tax rate environment that we've had during your lifetime. I'm more concerned about the future. We're forward looking. So on the right-hand side, the Oak Harvest plan, that's how much tax they were estimated to pay over the next 10 years. But now if you start to look out years 70 through 78 on this slide, this is where the tax saving starts to come in. And we know taxes will be higher in 2026, but I'm more concerned, what will taxes be in 2030, 2032, 24, 34, et cetera. Rolling this out to the next time frame from ages 79 to 96. Look at the amount of taxes they're paying if they followed the conventional wisdom advice. So huge increase in taxation. And of course, these calculations, they do not include what if taxes are higher in the future. 40, 50, 60%, all of that money inside your retirement account, it's not yours. You have a partner. It's Uncle Sam. And Uncle Sam can come in and change the rules at any time. And they could change as soon as November if President Trump loses the election, but we do know they're going up in 2026. And because of the amount of debt we have as a country, there's a very good chance, I believe, that taxes will be a lot higher in the future. So a couple things I've highlighted. If you look at age 85, now they have 1.8 million the Oak Harvest plan and 1.8 million with the conventional wisdom plan, but they're in the tax-free bracket forever. Their Social Security is tax-free, their dividends and capital gains are tax-free, and they don't have money stuck inside that tax-infested 401k or IRA anymore. So this is just a quick Social Security analysis for them. And if we look, if they have a normal life expectancy, the Oak Harvest strategy was going to provide 2.1 million in Social Security benefits versus 1.58 million following the conventional wisdom strategy. If they have a long life expectancy, this is the green versus red chart on the right-hand side of that top slide, over $1 million in additional Social Security income by following the Oak Harvest plan. The crossover point is that bottom chart. So for them, it's about 78 years old. So if instead of taking it 62, if they did the restricted application strategy and then full benefits at age 70, they will have received more from Social Security around age 78 than if they had taken it earlier. So again, longevity comes into this. This is why I had that longevity slide there. Now, this is probably the most powerful chart of one of them in this entire presentation. So the top account value chart is the Oak Harvest plan. That green shows how much money of all of their accounts is inside a tax-free forever Roth IRA following the Oak Harvest plan. The bottom chart is the conventional wisdom strategy. Okay, so this couple, in both scenarios, we're not concerned about them running out of income. We're not concerned about them running out of money. But they also wanted to pass money on to the kids and grandkids. Very important to them. Let me ask you, which one would you rather have over the next 25, 30, 35 years? Not only with the Oak Harvest plan do they have about 2.5 million, if you see the y-axis on the chart there highlighted on top, they have more money because they're paying less tax, but it's all inside the tax-free Roth IRA. So if taxes go up to 50, 60, 70% in the future, Tim and Tina don't care. Whereas if they would have followed their advisor's advice and the conventional wisdom strategy, they wouldn't have ran out of money. They would have had less at about 1.5, but all of that money is still infested with taxation. And when they pass that money on to the next generation, the kids aren't really getting 1.5 million because they have to fully distribute it within 10 years under the new Secure Act law. What are taxes going to be at the top marginal rate in the future? I don't know. They could be 40, 50, 60 more, maybe 70+%. So obviously the top strategy is far better for Tim and Tina. And again, these are the reports that we're gonna go through with you when you schedule the phone consultation with us. Now, this slide is in here to talk to you about IRMA brackets. This is where people who are not planning are going to, because of required minimum distributions, are likely to fall into this Medicare taxation. So income related monthly adjustment amount is Medicare taxes if you think back to the Medicare slide. The light green on this bar chart shows the approximate required minimum distributions Tim and Tina would have if they followed the conventional wisdom strategy. So the law has changed. At age 72 now, you are forced to start taking money out of your retirement accounts. It's important to know that the percentage that you must withdraw annually increases. So it starts out at 3.65%, but it increases 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 into the teens that you must distribute from your retirement accounts. Because of these forced distributions, your RMDs a lot of times create excess income that you have to pay taxes on, which can bump you into the Medicare IRMA brackets. You also have net investment income tax, which is an additional 3.8% possibly, and any other tax that Congress comes up with over the next 20 to 30 years to help fill the budget shortfalls. It's important to note that IRMA did not exist a few years back. The net investment income tax, the 3.8% on your investment income, that did not exist a few years back, about 10. It was part of the Obamacare legislation. So Congress will come up with additional taxes, I believe, and depending on how much income you have will determine if you fall into those tax traps. by not doing anything with your retirement accounts, it will force higher required minimum distributions, which I believe could put you into a precarious tax position in the future, which then triggers these various tax traps, which could cost you thousands and thousands of unnecessary dollars in the future. The Oak Harvest plan is the dark green there. So on the bar chart, so part of the benefit of doing the proper Roth conversion strategy is you don't have to worry about this. Not only are you taking advantage of today's lower tax rates, but you're preparing for the future. And for Tim and Tina, they didn't have to convert their entire retirement account. It was about 500,000 that we were converting. But optimally, that made sense for them. It allowed more to stay in the tax deferred, about half of it, earn interest. But then once we got into the income distribution phase, we're able to spend that retirement account down, not broaching other brackets to create excessive taxation. So RMD is a big part of this strategy planning session. And here's the total summary. So without Roth conversions, Tim and Tina were going to pay a total of about $627,000 over the course of their retirement. The total value they are going to receive, which value is calculated by estimated income that you would spend in retirement and the amount of money left over at the plan's expiration. So without Roth conversions, following conventional wisdom, $627,000 in taxes. With Roth conversions, with the Oak Harvest plan, estimated taxes of $186,971. So that's over $440,000 in savings that Tim and Tina, if they went this direction, the conventional wisdom, that they would have paid that they otherwise would not have to. Do we have enough? How long will the money last? So this is what we call a coverage ratio analysis. So compared to your needs and wants, total assets, 162% they were covered. Will the money last for all their lifetime, their retirement? Yes, we have a great coverage ratio there. Now, so this is part of the overall plan. You see we have three columns here: tax deferred, tax free, and taxable. So this is, if you remember back to the bucket slide, income planning, where do I take money from and how much do I take from which account? So this is the retirement income strategy for Tim and Tina. There's more that goes along with this, but this is a very clear explanation of where their income is going to come from in retirement. This is what we're going to provide you if you reach out to us. Now, normally for our clients, we charge $3,000 for this type of planning. For the first 20 people who reach out to us today and schedule the conversation to talk about your personal situation, we're going to waive that financial planning fee. That's how important this is. But this is the withdrawal schedule for Tim and Tina, and this is what our clients receive. Now, how do I pay less tax? Again, this is the summary of that previous slide. Over $440,000 in saved taxes by following the Oak Harvest plan versus conventional wisdom. Now, the big question, if something happens to me, will my family be okay? The most punitive part of the tax code is when one spouse predeceases the other spouse and you go from the married filing jointly brackets into the single brackets. Every year when a client passes away, it's one of the hardest things that we do at Oak Harvest Financial Group, but also one of the most rewarding and fulfilling aspects of our job is working with the surviving spouse, working with the wife typically, and showing the planning that we've done, everything that we've done up to this point means that you're going to be okay. What this slide tells us is that I've highlighted 72 and 73, the years 2031 and 2032. This tax example shows what happens if Tim passes away at age 72. So when that happens, Tina's going to lose a Social Security check. She'll get to keep the higher one. One check goes away. So Tina's income will reduce. But if you notice the tax column under the conventional wisdom, her taxes increase by 60%. She's penalized 60% increase in taxes simply because her husband passed away unexpectedly. So guys, especially guys, when we talk about taking care of our wives and our families, ignoring this part of the tax code and this part of retirement planning is one of the biggest mistakes that you can make. On the right-hand side, the Oak Harvest plan. So we do see an increase in taxation going into the single brackets in that same year. It's actually a greater increase of about 100+% from $7,600 to $19,000 under the Oak Harvest plan here. But we're preparing for the future. Okay, this is what ages 79 through 96 look like for Tina following the Oak Harvest plan versus the conventional wisdom strategy. Total taxes, left-hand column, conventional wisdom, astronomically higher with conventional wisdom than with the Oak Harvest plan. Look at the balances. If we go out to 2055, the very end of Tina's plan expiration, age 96, she's estimated to have about $693,000 left inside that tax-infested IRA. But guess what? If Tina needs that money, she wants to take a large distribution for a nursing home, home health care, assisted living, whatever it may be, all that money is still infested with taxes. Whatever the tax rates are in the future, if she needs $200,000 for long-term care, she's going to have to pay taxes on that money. Whereas on the right-hand side, the Oak Harvest plan, all of those dollars, remember the chart I showed you earlier with the green bars? All of her money now is inside these tax-free accounts because she followed the proper, for she and Tim, the proper Roth conversion tax plan strategy. So in the kids, they'd much rather inherit 1.3 million tax-free than 693,000 infested with taxation. So big part of retirement planning here. Here's the comparison summary of Tim passing away unexpectedly at 72. So the total taxes without the proper Roth conversion strategy, over $800,000 for Tina. With Roth conversions, $268,000. So now we're talking more than a 530,000, I believe, reduction in income taxes and Medicare taxes and every other sort of tax throughout the course of her retirement. So very big, powerful statement here. Okay, so what to expect? We are going to slide across the screen the opportunity for you to schedule a phone conversation with us and simply see if these strategies, if applied to your retirement, if they can benefit you. I want to thank you for tuning in today, and we look forward to seeing you soon. So thank you very much.